Hello, YouTube. Is the bear market back and are we headed for a hard landing? Well, Jerome Powell speaks again on Thursday, and I guess it's going to be largely up to him. We're already down by 4% on the month, and this 30 years of history does not look good. We can note that the seasonality chart also says we should be going lower into the second half of the month. Fear is back, and the market is bloody red. Not only that, we have people calling for a 50% crash or a 25% plunge. We also know we have more than $7.6 trillion in U.S. debt coming due, and short sellers are reaping $13 billion in profit on small cap stocks. But there is hope. So if you stay tuned all the way till the end of the video, we're going to go through the secret to Warren Buffett's investing success, and it has nothing to do with stocks he picks. So please stay tuned, and we're going to go through all of that right now. Where I want to pick off is just thinking about the bear narrative. There's lots of things out there that people are getting scared about. U.S. debt, treasuries, maybe we can drop 25%, maybe 50. But where I want to start here is by focusing on these $13 billion in profit that investors made on small cap stocks, because it might tell us that we're actually going to be headed for a 10% plunge on the S&P, or the number that I've been looking at for some time at 4146. So if now we jump over here to IWM, we're going to note that we're already down by 10%. So after the short sellers came in, they cashed in their $13 billion in profit. But that wasn't enough. They've now taken the chart down by 10%. So now the fact that we've actually tanked that negative 10, if we go back here to SPX, it doesn't seem that far out of the realm of possibility that we could be going for, this was negative 20. Well, we could be headed for negative 10 all the way back down here to our relative low. What's the one pattern I'm watching for? Well, it's this one right here. And the reason why it's so important is because we're closing below all support that we've now formed. This is now starting to form an M. And if the M completes, it should come back down to roughly 46, or the 50 MA on SPX, which would equal a 10% drop. This chart is the most important one because it's led to every major drop so far this year. We're focusing on the periods that have been a little bit more predictable. But as we zoom out to a higher time frame and we're approaching the end of the month, well, we did not hold the monthly low. We have a monthly lower low right now. And we're not quite sure if we're going to do number 5 if we can't complete number 4. What I would also note here is just that we're also right around our Fibonacci area here at 4311. We're currently here at 4320. So if this level does not hold, it's not a really good omen. It's not a really good omen because it doesn't look like we're actually going to go into bull market, and objects in motion tend to stay in motion. So if we're closing at or near the low of the week, like we did last week and the week before, what does that mean? There's pressure building up to the downside. So if we now go back here to SPX, I just want you to pay attention to one thing here. So we note that we have this big, nasty red candle, but now I'm going to pop over here to SPY to look at a different chart because it's the same thing. 42961, what's our low? 42999, right around that mathematical number. But here we're looking at 43301. And I want you to pay attention to this because it's subtle, but we went through this on the Friday stream. So if we look here at a 15-minute chart, note what happened into the close. They tagged 43321 exactly here. And then we just faded to close down at the low of the day and the low of the week and the low of the month. Why is that important? Well, because people don't want to hold on to risk going into the weekend. So generally speaking, when we close at or near the low of the week, it usually means there's more downside pressure. Normally, what will happen is that if we're going to get a reversal, we will gap down, pump up. So that's normally what will happen here. So if we do gap down into Monday, I will be watching for that. Notably, on the one-day chart for SPX as well, we're leaving a double gap here. We got one gap here and a second gap here. Why is that not good? Well, because we did the same thing as we were starting to advance higher on the S&P 500. So we know we have a gap, we have another gap, and now these other gaps have been kind of filled here. So when we started to leave these gaps to the upside, we left 1, 2, 3, 4, and then we finally exhausted. So now maybe we're going to leave these upside gaps until we find some true support. Where could that be? I'm looking at 4190 here, which is going to be that 200-day moving average. And then we also have 4142, which is going to be our 50 weekly moving average, or really strong support. And then also that technical 5% drop off the high. We know that 5 to 10% drops are normal, and we've reviewed that before, but this is really the most important chart we're going to look at. So what I'm going to do now is ask you for a huge favor. If you could please consider smashing that thumbs up and subscribing to the channel, I would really, really appreciate that. We do put out stock market videos every single day, and I appreciate your support ahead of time. All right. So Jerome Powell, what's he going to do? Well, he's not likely going to talk about monetary policy, but I know everyone's going to be watching for it. So we're going to go back and look at some charts a little bit later, but I really want to set the stage here for the rest of the week. And please note, I will make an effort to upload videos this week, but I likely will be away from Monday to Wednesday. So if right now we only went down and then down more for the month, we're down by -4. It means that we're starting to repeat this. -10 would be what we would need to do minimum to repeat the previous pattern where we have 1, 2, 3, 4. For what? For the month of September being the weakest month of the year. So we got 4 in a row. Each time it gets a little bit worse. Well, 1, 2, 3, and maybe 4. We're currently at about -4.5%, which means we're in line with where we were in 2021. What's so interesting, though, is that we did not go up into the first half of the month. We just went down and then down more. We can see that here by us opening the month at 45.30 and just selling off the whole month. Nice. If you've been watching your portfolio, you've probably been noticing it went down, down, down. That's right. Fear is back. And what's the saying? Do we buy fear? Do we sell fear? Well, fear means we're probably going lower. But again, that quote from Warren Buffett, we're going to come back and talk about a little bit later. This is going to be very important. So the saying is that you buy fear, sell greed. Well, we were extremely fearful a year ago. We were neutral a month ago, neutral a week ago, fearful on Thursday, fearful on Friday. But is it going to go into extreme fear? That's what's going to tell us whether or not these discounts are going to get deeper. So when we look at the market on a one-day performance, it's a little bit mixed. We look at the last 1 week. It's pretty obvious everything is selling off. It's also pretty obvious that when we look at the 1 month, it's looking a lot more mixed. We look at the 3 month. Things are starting to look better. They're definitely mixed. There's lots of rotation. But if we look at year to date, there's Mr. Green, our old friend. If we go back a year, it's getting a little bit smoother. So is plus 14, plus 200, plus 31, plus 33 good enough? Well, it depends on your time horizon. If you're looking at the last 1 week, well, you're only focused on the red. But again, that quote from Warren Buffett is going to really help us to make sure we understand that when in doubt, we want to zoom out. So we already know that short sellers are making attacks on individual stocks. And this is one thing I'll be watching for specifically to know whether or not we're going to get continuation into the broader market and notably S&P 500. So last week we saw a CFTC net short positioning of 116,000 contracts, which is the shortest number going all the way back here to basically when they started the short, going back to June of 2022. But now we're noticing that they are starting to add back. It's a marginal increase for a near 3% decline, only adding back about 20,000 contracts. It's not really all that much. But if we continue to form those lower lows or they continue to short it like they did before here, we note that they go short, they go big short, then they double down, then they cover into what? They cover into the strength. So if they're shorting the breakdown and they covered the rip, do we really want to trust this data? Well, it's a really interesting data point, but that's all it is. It's just a data point. This is important, but what will be more important for me this week are the things that are underlined here on the calendar. We have consumer confidence coming out on Tuesday. I think that'll be important, but the most important data points will be where the stars are. So on Thursday, we're going to have initial jobless claims in the morning, a revision to GDP Q2. So if we're going to go into a hard landing, maybe that's going to be the clue. I don't personally think so because it's a revision, and we're expecting a revision higher. And that could be largely due to right now, we got GDP now for the third quarter right here at 4.8%. It came down a little bit, most recently updated on September 19th. And then we got the big man talking at 4 o'clock on Thursday. Why does that matter? Well, because Thursday at 4 o'clock is when the market closes. And then overnight from Thursday into Friday, pre-market, we're going to have that PCE number coming in at 8:30 a.m. This is the Fed's preferred inflation gauge. And if it comes in at negative 0.2, I think, again, not I know, but I think that will be interpreted as bullish. We don't yet have the estimate for the year over year, which will be a very important number for me. And this is important because we want to make sure we understand that a restrictive stance from the Fed means that we take the current rate of inflation or the PCE, which is the Fed's preferred inflation gauge. We add 1.5%. So we go 4.2 plus 1.5. That equals 5.7%. We're currently at 5.3. So what does that mean? It means we want to see progress on that PCE number coming down. Otherwise, the Fed might have to raise one more time. As of right now, they've done a whole bunch of nothing at the last few meetings. That doesn't mean it's going to continue, though. And if the risk is that the government could shut down, we might not get more economic data between now and when their next decision will be, which means that this number is going to be very important. Why? Because we want to see whether or not the trend is continuing where we have a high, lower high, lower high. Is this going to be the next lower high? And if we fall back down below 4, then where are we sufficiently restrictive according to the Fed? Well, if we're at 5.3 and we remove 1.5%, we need to be at 3.8. So for us to be at 3.8, we need to see a decline from 4.2, which is where we are right now, all the way down to 3.8. I think that's what it's going to take for the Fed not to hike. We can also look at the Fed Watch tool, and that'll basically tell us here that if you look here to the forward estimates for the rate path in November, we're expecting a pause. So when they say higher for longer, the market's already largely there. But we are going to look at the 10-year Treasury note because that is flashing a crash signal as well. Pause going into December, a pause going into January, a pause as of right now. The most likely scenario is a pause for March. It's a pause for May. It's a pause for June. Okay, what about July? There's the first rate cut. It's in July. When did they first start hiking? Let's go to the Fed funds right here. So they stopped hiking here in August. So from August until July, if we just try to make sure we're being a little bit objective here, so that's 11 months. Okay, so I've been asking myself whether or not it's 2007 or 2008. I know it's subtle, but I think it's kind of really important here. Why? They raised at the most rapid rate going back to the 1970s. Well, this time's even faster, and they raised to a higher terminal rate, which means we're currently at 5.3. And back in 2006, we were at 5.25. However, look at here, July of 2006 until July of 2007, or 12 months, what do they do? Well, they hold interest rates flat. What does that mean? That's the Goldilocks period where the Fed is pausing. They're not pivoting. Pivot or bearish. So the majority of declines happen in a bear market. Let me see if I can pull that graph up again after a pivot. Because if we're going to go sideways for 12 months, like that's like a really long time between now and like the end of the year. So I'm not quite sure that people are really ready for what this could mean. Everyone's cheering for a pivot or a rate cut. I don't want to pivot. That means things are going to probably get worse from here. So let me see if I can pull this graphic up here. 1 second. My apologies. Should have had this ready before. Here we go. So, oops. I think this image is actually better here. Let me see if I can pull this one up. Just doing this on the other screen. Here we go. So let's pull this one open here. And oops, I think I closed the wrong. There we go. Close that one right here. So the majority of the declines in a bear market happen after the Fed's pivoted. So I'm bullish on a pause. Why? Well, I think that there's always a period of equilibrium where we are waiting for those delayed effects from the Fed to actually kick in. What always happens? Well, pause and then cut. The gray area is going to be the recession. If we go back in time, right? They pause, recession. I don't know if that's a pause, recession, pause, recession, pause, recession, pause, recession, pause, recession, pause. So there's a delayed effect between the pause, the pivot, and then the recession. Pause, pivot, recession. Pause, pivot, recession. Why would this time be different? I don't know. I think it's going to be exactly the same. It's always the same. So why would this time be different? I have no idea. I think it's going to be the same. So when the Fed pivots, that's when we get things like a negative 36, negative 48, negative 27, negative 51, negative 58, negative 35. A pause is bullish. A pivot is hawkish. So there's a double-edged sword here. But before we go further, I want to look at the 2-year note and the 2-year note and the 10-year note. Why? Because they're both giving us different signals here. We can note that the 2-year note, or the expectation for short-term or 2-year Fed funds or inflation, is basically topping out. Top, double top, triple top, quad top. It's basically fine. It's not able to breach this 5.2 area, which means the 2-year note is basically going sideways. Here's the challenging part. So this is bad, but this is worse. So this one here is no bueno or no good because it keeps forming those higher highs. So the high that we established going back to October of 2022, which is really when the market bottomed, right? The market tanked going into October. And then when yields came down, that's when we actually started to see that relief on the market. As a reminder, right here in October is when we actually bottomed. So this crash right here, it corresponds with the 10-year note. So as the 10-year note is rocketing higher, we get that crash. Well, what have we been doing? We've been stair-stepping higher. So if we're going to get another crash, like it's already telling us that when we breach the high, like we form a W and break over, we form a W and break over the relative high, we usually go lower. That's the bearish case. That means stocks are going to go down. We look back to here, well, March of 2022, that was no bueno. That's exactly what we're looking at right now. That's the period on the 10-year note when it went higher. We can also look back to 2018 in January, which is when we saw that other breakout. Well, look right here, negative 10% in 2 weeks. That's pretty nasty. So we could definitely repeat that chart I looked at before, where we could be getting that big fade lower. I'm just not 100% sure. Why? Well, I'll show you a few things here. So what I want to show you is going to be, we looked at the Fed tool. We know when the first rate hike is now priced in. But what I want to look at next is going to be whether or not the market is actually more or less expensive relative to where we were in the past. And this might seem like really simple, but I want to go through and tell a little bit of a story. And the reason why is because we've actually been seeing PE revisions getting revised higher. So here going from 2022 down to the bottom into early 2023, what do we know? Well, it's pretty obvious. S&P 500 earnings per share or EPS gets revised lower. And then Q1 earnings season begins, they get revised up. And then Q2, they get revised up. We've not yet seen that Q3 number. So what does that mean? Well, let's look here to the graph. Going back for the max period here, we know we had a high of 33 going back to 2001. Then we crash all the way down to 18 going into Q2 of 2022. Then we rally back up to 25. And now we've actually been fading. Why? Because the price is going down and the earnings are going up. So there's two numbers, right? There's the price and then there's the earnings. So the PE, if the price goes down and the earnings go up, things get cheaper. They're as cheap right now as they have been going back to 2022. And we've actually come down quite a bit. So what does that mean? Well, it means that when we look at the current heat map, it looks pretty red. And for the current PE, it looks fairly expensive. As a reminder, the guide down here tells us that the closer we get to 30, the more expensive it gets. Well, Amazon at 100, Tesla at 69, Meta at 33, Google at 28. These things all look expensive. But remember, the market is a future discount mechanism. That's why here we're looking at the forward estimate. That's what most important people care about. So when we look here from PE to forward PE, it looks a lot less expensive. Why? There's not a lot of blocks that are deep red or that 30, which means actually right now, that quote from Warren Buffett is going to become very important here in a minute. So when we look here, things don't look all that expensive, right? Healthcare looks good other than Eli Lilly. Energy looks good. Real estate looks expensive. Financials look solid. Tech is mixed, but there's not a lot of pockets of over euphoria. We look here and note that Apple's at 26, Microsoft at 25. Hey, that seems reasonable. Why? The overall market is priced here at 19. And then Magnificent 5, Magnificent 7, well, 25, 26, that's not bad. Tesla at 52 is a little bit rich. Amazon at 40 is rich. And where's NVIDIA? NVIDIA at 24. Oh my goodness. What does that mean? It means the most recent drop in price has made the earnings more attractive. So the market doesn't really look all that expensive in my opinion. All this depends on whether or not we actually get a rate of decline in inflation and whether or not we really come down to have that recession. All right, so before we look at the Warren Buffett quote, I just want to reiterate the reason why this chart is so important. And before I do that, I'm going to ask you one more time, if you could please just consider subscribing to the channel. We publish stock market videos every single day. Thank you ahead of time. For me, what's really bad is when we're looking at a period. Here I'm looking at the monthly, and we close a candle below it for the closest time frame. So for the monthly, for me, that would be the weekly. So by us closing the weekly candle below the monthly low from last month, it's not good at all. If we close the if we close the week red again, usually when we have 3 weeks and no recovery, it usually leads to a slide. 1, 2, 3, 4, 5, 6, 7 weeks in a row. That's nasty. That's not fun at all. So are we on track to do that right now? We're gonna have to make sure we watch that level really close. So on SPY, it's gonna be 433. And then I'm kind of thinking like the last level of support here is going to be 429.61. Basically, if we print a weekly lower low, we're probably going to be losing this area. We really want to get back above 433 at a minimum for this to be a failed breakdown, That's really what we want to see. But since the market looks cheap, And we know that Warren Buffett is arguably the most successful investor of all time. Let's see whether or not we can understand what's led to his secret to success. It's not that complicated. Let's go through here. So I'm going to read this one part now, and this really dovetails what I mentioned on Thursday and Wednesday when I mentioned my personal investment strategy. Buffett is good, but not the best. Over the course of his career, Warren Buffett has generated annual returns averaging 22, an incredible record that approximately doubles the S&P 500. But that's junior compared to Jim Simons, blah, blah, blah. Oracle is proof that there's no substitute for an early jump. Buffett was born in Omaha in 1930 and quickly displayed a penchant for wealth generation as he sold chewing gum and Coca-Cola, blah, blah, blah. Where's the part I want to get at here? In 2016, Buffett said, the money is made in investments by investing and owning good companies for long periods of time. If they buy good companies, buy them over time, they're going to do fine 10, 20, 30 years from now. That's what I also mentioned. I mentioned 30 years. So what if Buffett had been a typical investor? What I'm actually looking at here is a number 40. So let me see if I can find that here. All right. So here's the part that makes Warren Buffett different. The Oracle is proof there's no early substitute to an early jump. Here we go. Here's the part I was looking for. Buffett was hardly the only kid hustling for pennies during the Depression, but at 11 years old in 1942, he launched a lifelong love of investing when he bought his first stock, 3 shares of an oil company called City Service at about $38 per share. According to CNBC, he sold the shares soon after for $40. After celebrating a $6 profit, the young Buffett watched helplessly as City Services climbed to $200 a share. Ever had anything similar happen to you? It was the hardest but most valuable lesson of his career. The key to investing success is to compound gains by buying and holding them for a long-term time. I just showed you the market's cheap, and with us currently getting discounts in fear, and we buy fear, sell greed. Buffett told us what to do here. So what does that mean? Hold on to investments for a very long time. So that's pretty much it. Find good companies, buy them at a discount, hold on for a long time. That seems pretty simple. Let me know in the comment section whether or not that's something you think you can actually do, where you do something once and then do nothing. If not, the weekend deep dive from last week is now queued up here, where we talked about how the stage was set. And if that does not interest you, then maybe you want to see what I'm going to do after I sign off YouTube. You can trade with me for 14 free days by going to thealgo.com to trade with me, Justin, from YouTube. I look forward to seeing you on the next video, but remember, that might be as late as Thursday because I'm likely going to be away from Monday to Wednesday. Thank you so much for tuning in. I look forward to seeing you on the next one.